So look, total liabilities uko na bank loan na uko na creditors. So you add those. So add liabilities in year 2. You'll have 1425, you add 810. So that gives us liabilities of 2235. The difference is the net assets. So that's now you can get change in net assets for 2017 by getting this one. Get something like 195. So confirm the figures. Then 2018, again, we're given the total assets. In 2018, the total assets are 5711. .35 in thousands of shillings. And liabilities we have to get. So liabilities will be the bank loan plus creditors. So the bank loan is 1566. Creditors is 891. So the liabilities is 2457. The company is winding up. The promoter shall be realized. $20, $32. Okay, 3254.35. So 3254.35. We subtract 28, 44.34. We get net assets of 410. 410. 2019 total assets is given 5927. Again, total liabilities will need to add the bank loan of 1716. 1716 is bank loan plus 972. 2688. So subtract here 2688. The difference would be the net assets. Which is 32, 39. Now there's a decrease in net assets there. negative 0.85, 0.35, 15.35 negative. So that. Then the last year is 2020. So in 2020 again, total assets is given is 6182. Total liabilities will add the bank loan of 1866. Add plus creditors of 1053. And the total is 2919. So that should give us net assets of how much? This is 3263.5. So up to there we have the profit before adjustments, then the adjustments are in additional information. For example, note 1 has personal expenses, which will also include note number 3, salaries paid to Linda Obadi's husband. So we'll add back disallowed expenses. So disallowable expenses will include, for example, repairs of house. So repairs of house is 172 in 2017. So in 2017, add back 172 for repairs of house. And we again add in 2019, we add back another 180 for repairs of house. Then there is house manager salaries, house manager's salary. House manager's salary is 259 in 2017, so 259 in 2017. Then you have 302. 302, then you have 344. You have 344, then you have 358. Then you have cash withdrawn or cash drawings. So cash drawings, we have 192. All these are called personal expenses. They are personal expenses. We have 220 or personal expenses or personal drawings, 300. 340, we add back. We also add back school fees. So school fees is 228. Just 228. Then you have house expenses. House expenses is 163. Then you have 331.6. Then you have 356. Then you have 382. Yeah. Then you have note 3. For the year ended 31st December 2017, salaries paid to Linda Obadi's husband. So, on a husband's salary. For 2017, it was 312. Then that 312 will be increasing by 15% every year. So 312 in 2017. So here is 358.8. And you have 412.62. And you have 474. 51. So those are our adverts. Then we deduct so our deductions, we have non-business income, C note 2, like rental income is non-business. We deduct rental income. Rental income is 182 for 2017, then 166.56, then 150, then 218. Then you have interest from bank deposits. Interest from bank deposits would be 2.75. Then you have 14.97. Then you have 20. Then you have 22. Then you also have note 4. She received 360,000 in cash as inheritance in the year 2019. So you deduct inheritance because it's not part of business income. So in 2019, it's a 360. So 2019, we remove 360. So this should give you the estimated. $20.39. 2019, 807, 807. So what must be confident now about capital statements? You still have doubts. But this was the simplest of them all. We're gonna marks ngapi? Marks 10. Examiner alijua. It doesn't take much. But you have to know exactly what to put in the statement. That's a direct one. So there's a second part which says, describe the factors that a revenue authority considers in ascertaining the adequacy of the living expenses and above duty investigations. So how does the revenue authority ascertain whether what has been put as living expenses is adequate or not? Maybe they'll check at the lifestyle of the taxpayer, the cost of living, is it realistic? So you're getting different answers for 2019. What are you getting for 2019? 1077. 1077.27. Okay. 1077.27. Then you can look at Roman 2, factors that a revenue authority considers. Factors that the revenue authority will consider. Factors that the revenue authority will consider. Factors that the revenue authority will consider in ascertaining. Factors that the revenue authority will consider in ascertaining the adequacy. Factors the revenue authority will consider in ascertaining the adequacy of living expenses. Factors the revenue authority will consider in ascertaining the adequacy of living expenses under back duty investigations. The adequacy of living expenses under back duty investigations. Factors that the revenue authority considers in ascertaining the adequacy of living expenses under back duty investigations. The first factor, the trend, for instance, whether it is increasing, the trend, for instance, whether it is increasing, decreasing, the trend, for instance, whether it is increasing, decreasing, or constant, whether it is increasing, decreasing, or constant. Next one, cost of living. Cost of living. Cost of living. Cost of living. Another factor to consider, marital status of the taxpayer. Marital status of the taxpayer. Marital status of the taxpayer. Another factor, lifestyle of the taxpayer. Lifestyle of the taxpayer. Lifestyle of the taxpayer. Next one, the number of family members. Number of family members. Number of family members. Maybe one more factor, the rate of inflation. The rate of inflation. The the rate of inflation in the country, the rate of inflation in the country. So are we okay with back duty and capital statements? Mko sawa, si ndio? Kila mtu ako sawa, eh? But you can try for your own exercise. Actually, hiyo question imebaki peke yake. Unaweza kujaribu November 2020 question 4. It's called Anita Warazo. November 2020 question 4 is called Anita Warazo. You could maybe use that for maybe further practice for yourself. Then we can look at some VAT. There's a question about contracts or property developers. Kama kuna watu bado wako na shida na contract, we can look for one. Kuna question tu moja imebaki, but we can, I don't mind doing it. Kuna question here, December 2014, I think. You can use that as an illustration for contracts. There's a question in December 2014, nafikiri question 2. December 2014. Yes, question 3, not question 2, question 3. Inaitwa Zawadi. December 2014, question 3B. Inaitwa Zawadi Contractors. December 2014, question 3B. December 2014. It's called Zawadi. Zawadi Contractors. So the question says, Zawadi Contractors Limited operates in the construction industry. On 1st November, the company was awarded a tender by a manufacturing company to construct a godown and staff quarters. Construction of the 2 buildings commenced in January 2012. The following details relate to the 2 projects for the year ended. So we have opening balances in January, materials on site, the written down value for plant, cost of work done, cost of work certified, transactions undertaken during the year, your material delivered to site from stores, from suppliers, plant purchased at cost, subcontractors fee, consultancy, inspection fees, salaries and wages. Then you have head office expenses, materials transferred out, material sales, plant lease charges, direct expenses, cash received from client, cumulative value of work certified as of 31st December 2013, value of work uncertified during the year, balances carried forward, materials on site, accrued wages. Additional information, consultancy fees was overpaid by 10,000 for go down and 4,000 for the staff quarters. Direct expenses accrued and not reflected in the accounts was 300,000 as of January 2013 for the go down and 2 million shillings and 500 as of 31st December for the go down and staff quarters respectively. 3, included in the materials from stores, from suppliers for the go down is material worth 2 million used to construct a toilet within the premises. Then they've said ignore capital allowances. Required statement of taxable profit or loss arising from each of the 2 projects for the year ended 31st December 2013. And then tax payable if any by Zawadi Contractors Limited from the computations above. So we'll prepare a T account, then you can get the direct costs which can be debited in the T account. So this is December 2014. So we are preparing a contract account. This is a project. And there are staff quarters. So we get the cost of materials for now. So you can use a T account ama unaweza ku just add them. Either way can work. So you can get the direct cost of materials by maybe just adding, or you prepare a T account for the go down, and then you can also get for that for staff quarters. And we can start with the go down. So materials itakuwa ngapi? Hebu jaribu ku work out. So materials ni ngapi for the go down? Cost of materials. Unapata? 97. Are you getting 97,000 for materials? So let's add together. So these go down. Opening balance is 8,500. So we start from there, 8,500. Then there are deliveries. From stores is 15,000. You add to 18,500. Other deliveries are from suppliers, another 120. Add. Then your materials transferred out, you subtract, minus 15,000. Material sales, you subtract 5,000. Then materials at the end of the year, balance carried forward is 31, you subtract. You talk what you have is 9,500. So the end of materials happen in 95. Sasa tafuta ya staff quarters. Hakuna adjustment moja hatujafanya. Angalia note number 3. One more adjustment. Included in the materials from suppliers for the go down is material worth 2 million used for construction of the toilet. So you are went up as part of the site. You will end up for something else. So from 90,500 to the 2,000. So inabaki 88,500. Sindio? Unatoa the 2,000 inabaki 88,200. 88,500. So itakuwa 88. There's some 2,000 that was used to construct a toilet. So it was not part of the contract cost. So 88,500. After direct cost here, material here, your staff quarters. I think we'll also take a break in the meantime. What happens if you transfer you will still remain here, and the person who gives you a share will but if you transfer all your shares, you will cease to be a member. Number one, you will cease to be a member.
Next one, your name shall be removed from the register of members. Your name shall be removed from the register of members. The possible representative of agents, when it's the end of the member, the possible agents or representative of the member, if they agree, they shall become the member. But it's the end of the member. They are personal agents or representatives. If they agree, they shall become the member. There is bonus. There is bonus. The trustee of the shareholder. The trustee of the shareholder. Where any dividends were paid and you did not receive your dividend, you shall you are entitled to the name to be when your name was removed, some people you're supposed to make whereby the purchaser of the shares that name was entered the register and you are given a share certificate, the name shall be removed and the share certificate transferred. Please let us go to the chapter of shares. Let us open there. What is transfer of shares? Thank you, Madam. Okay, very techniques like where you have numbers. You want to give like states or kind of so. My character was not good money is up this. I know with some of my brother.
So material cost umepata ya staff quarters ni ngapi? 72,500. So we're in agreement, this is 72,500. 72,500. Hiyo ni materials. Then kuna kitu inaitwa salaries and wages. Tafuta salaries and wages. Again, you can get salaries and wages for the go down. Alice pia alikuwa ametupatia 72,500 hapo. 72,500 for materials, yeah, staff quarters. So let's get salaries and wages. $175, $150. Na wengine wanapata nini? 175, 800. Salaries, ndugu zetu online. Anybody else? 175. Sasa salaries utachukua this transactions during the year, salaries and wages, they want 75,000. So they are 175,000 minus accrued at the beginning of the year, 2,000. Then plus accrued by the end of the year, 1,200. You should be able to get 174,200. Sindio? You 174,200. Huh? So nachukua 175. Hiyo ni cash, transactions during the year minus 2,000, that's accrual opening balance, plus 1,200 accrued by the end of the year. 174,200. This is 174,200. Salaries and wages ya staff ni ngapi? Staff quarters.
However,
150. 150, 600.
And the Lord is in our prayers. The bank finance.
So 150, 600. That is salaries and wages. The next cost should be, we need to get an allowance for plant. So investment allowance for plant. So the rate will be 10% other machinery. So the opening balance for go down is 320,000. Then they have plant purchased. So they don't have. It's a dash. So they will only use 320,000. 10% will give us 32,000. Plant for staff quarters is 125,000. Then, do they have plant purchased? Yes. They have 145,000. So opening balance is 125,000. Add purchased, another 145,000. So that's a total of 270,000. 10% will be 27. 10% is the rate for investment allowance for other machinery. We don't need cost of work done right now and cost of work certified today, to need them later. We go to transactions during the year. Materials tumemalizana nayo, plant at cost tumemalizana nayo. We'll bring in subcontractors fees. Subcontractors fees is 145,000. So subcontractors fees is 145,000. That's subcontractors fees. Consultancy, kuna adjustment in note 1. Consultancy fees. So consultancy fees is 35,000. Then note 1 says 10,000 was overpaid for the good down. So 35,000 minus 10 is 25. So consultancy actually is not true. It's 35,000 minus just 10, which is 34,990. This is 34,990. It's 35,000 minus 10. 34,990. Then the other one, consultancy, is 36,000 minus 4. 36,000 minus 4 is 35,996. 36,000 minus 4 is 35,996. Inspection fee. So inspection fee is 15,000. and 7,500. That's inspection fee. Salaries tulimaliza. Head office expenses is not a direct cost. Materials transferred, material sales will bring in plant leasing charges. So plant leasing. So they leased additional plants, so we have 350 for plant leasing and 550. So plant leasing, then we have direct expenses. Direct expenses as adjustments in note 2. For example, direct expenses for go down is 4,000. Then note 2 says direct expenses accrued and not reflected in accounts was 300 as of January for the go down. So 4,000 minus 300 here January minus 300 as of January for the go down and 2,000, then 500 as of 31st December for the go down. So we add 500 as of 31st December for the go down. So that's 4,200. So direct expenses. 4,200. Direct expenses for the other one is 4,000 plus 2,000. No, minus 2,000. This is the balance in January. Direct expenses accrued and not reflected in the accounts was 300 in January for the go down and 2,000. And 2,500 as of that 1st December. Direct expenses accrued and not reflected in the account is 300,000 as of January for the go down and 2,500. These ones are as of December. So 2,000 near go down. Now 500 near then nimekosa ile ya kwanza. So it means tutachukua direct expenses they are 4,000, tutatoa 300, then you add 2,000. So that's 5,700. Na ingine is just 4,000 plus 500, which is 4,500. Because 500 is at the end of the year for staff quarters. So we just add that. So that's done. Direct expenses. Cash received from client is not an expense. That's cash received, you just debit the bank account and credit the client. So it doesn't come in the contract account. Then cumulative value of work certified at the end of the year will subtract cumulative value of work certified as of January to get value of work certified for this period. So value of work certified. So that's what cumulative value of work certified at the end of the year, 990,000 minus cumulative value of work certified as of January, which is 250,000. The difference in Apongapi, 740. So 740,000. You need value of work certified. The value of work certified is like the payment that they're expecting, like the sales that has been made. We do the same for staff quarters. 745,000 minus 130,000 will give us 615, 615,000. So this is 615. So that's value of work certified. Then value of work uncertified is the closing stock. So put your value of work uncertified.
6 hours and the duties of the campus.
Value of work uncertified is 35 hours.
They are the youth to register the child. They are the duty to maintain the campus.
So this then should be able to give us the contract profit. So say contract. We carry it down because we are yet to deduct other expenses like the office expenses. So the office expenses is not a direct cost, so we charge it. So we need to get the profit by deducting the direct expenses.
If you change the name of the company, if you change the address of the company, if you change the color of the
the taxable profit, so we use the percentage of work completion. The percentage of work completion will get cost it certified. You divide by estimated cost of completion. At that point, you can multiply by the profit, or you can multiply by the percent. First, we'll straight away multiply by the profit. So we'll start with the go down project, go down. So to get cost to date, so cost to date, we get this total minus the profit. It will give us the total costs. So if the total cost of expenses can be gotten by, you get 775, the contract price of value of work certified minus 424, 260. So the cost to date certified is going to be 350, 740. This will divide by, you want to get estimated costs until the end. So we have cost in January, opening balances. They've given you cost of work done as of January. For the go down is 300. Cost for this period is 350. It's 350, 740. What is remaining to the end is 35. Then I get that as a proportion of our profit. Our profit is 424, 260. That should give us the profit to take, or profit recognized, or taxable profit for the go down project. Then we do the same for the other one. It will be 659. This one minus this one, it will give us the direct costs minus 215, 354 will give us the direct cost of 443, 646. We divide by cost to complete. We've given you the cost up to January is 250. The cost for this period, the cost remaining to be done is 44. The profit is down here is 211 after deducting a quarter, and the office expenses is 211. You can confirm the figures.
If you want to sell off, if you want to sell off commercializing companies, they can't do it on their own. They must get their own. If the regulator wants to sell off the company, they can't do it on their own. They must get their consent. Payment of creditors, payment of creditors, payment of creditors. You can't pay off the creditor without the court approval. To appoint an advocate, to appoint an advocate, to assist in the performance of the duty, to appoint an advocate to assist in the performance of the duty, to appoint an advocate to assist in the performance of the duty. Next one, to compromise all calls and liabilities. To compromise all calls and liabilities.
Then, of course, for Roman 2, tax payable will be corporation tax multiplied by 30%. So for corporation tax, you just multiply by 30%. So you can multiply that by 30% and you get corporation tax.
Alright, so 5 grams for the compulsory liquidation of the contract. 5 grams for compulsory liquidation. 5 grams for compulsory liquidation. 5 grams for compulsory liquidation.
And you want to look at VAT. So there's a VAT question called reward or reward investments. It's December 2021. But before that, you can even do a question on double tax relief. There's one question in May 2021, question 3C, inaitwa Ali Salama. May 2021, question 3C is on double taxation relief. May 2021, question 3C. Tafanya hiyo Ali Salama, then we look at VAT. May 2021, question 3C. in 2021, question 3C is double taxation agreements. So May 2021, question 3C says this. Ali Salama is a resident taxpayer in Kenya. During the year of income 2020, he had 4,380,000 from employment in Kenya. He had also received 480,000 from the United Kingdom, which had a double taxation relief treaty with Kenya. Tax deducted in UK was equivalent to 80,000 Kenya shillings required. Double taxation relief and taxpayer. The examiner amepeana marks kidogo sana because anajua ni kitu rahisi. So why don't you do that? Get double taxation relief and get the taxpayer. Double tax relief is only 4 marks because anajua ni kitu rahisi. Anajua it's not complicated. Ni incomes mbili tu ya UK na hapa. Then you get taxpayer. Natafuta nini? No, natafuta kwa bidii sana. Natafuta. Because tulifanya cross border juzi. Na maswali yale tulifanya yalikuwa marefu, sio fupi kama. So kwanza unachukua income ile ya ng'ambo. So income ya UK ilikuwa ngapi? For 80. For 80 was the income in the UK. So unasema employment, unaanza na hiyo ya ng'ambo. The UK. Kenya. The Kenya ndio 43. Hizi mbili tunapata total. Total income itakuwa 4860. Tunatumia graduated scale kutafuta tax. So unatafuta A kwanza. A itakuwa difference between tax on total income minus tax on income from Kenya. Itakuwa kupatia element A. Element B ya kucompare tayari tuko nayo. The ile tax ilipwa in the UK which is 80,000. We already have that. So unatafuta A. You calculate Kenyan tax on total income minus Kenyan tax on income from Kenya. The difference will give you Kenyan tax equivalent on the income that was derived from the UK. You compare the tax that was paid in the UK, which you already have. So Kenyan tax on total income. Total income here, unatumia graduated sales on the first 288,000 at 10% will give us 28,800. And on the next 100,000 at 25%, give us 25,000. In excess, it's a 448.60. That's Kenyan tax on total income. Yes, Kenyan tax. On Kenyan income. Kenyan income is 43,80,000. So do the same thing. You subtract here to get your A. The difference here is what we call A. And 144,000 is what we call Kenyan tax. Income from foreign country. On 25. Is on 25. Is this okay? 1197,600 is okay. Okay, then you get this one is on 25. Yes. On 25, 140. On 25, 400. 1251,400.
Yes.
It's 144. So that's the equivalent Kenyan tax on income from foreign country. That's income from the UK. But then you already have B. B is what was paid in the foreign country. So tax paid in the UK in the Olsemani 80,000. So the tax paid was 80,000. Then you compare these two. The lowest is your double tax relief, the lowest. The lowest between the two is the double tax relief, so 80,000. Now that you have that, you can calculate the tax payable by Ali Salam. You can calculate the tax payable for Roman 2. See how much you get for tax payable. The gross tax liability was on total income of 1395,400. Less than double tax relief. Double tax relief is 8. Then you can go try insurance as an assignment. Unaweza jaribu December 2021, question 3B inaitwa reward. December 2021. Question 3B inaitwa reward. Investments limited. That's VAT. So we'll be doing VAT and maybe any other thing that's outstanding. Ni topic gani tumeacha bado hatujafanya? Apart from VAT, kuna ingine? Ama tumemaliza? Is there anything else apart from VAT? Anything else? Anything else apart from VAT? So for VAT, you can also see what the mark again. There's another question in there's another question called Zawadi. Zawadi is May 2016. May 2016, question 3. Shall be looking at 3A and B. May 2016. Angalia A and B. We look at tax information exchange agreements, which is supposed to be part of cross-border. And then maybe tutafanya pia tax planning. You still remember tax planning, eh? Yeah, we'll do one more question on tax planning. Then tutasema tumemaliza, unless maybe you have an area you want us to cover. Somebody is saying PE. Mary, what do you want us to cover in PE? Income tax. Okay, we'll get a question on income tax investigation. Question in income tax investigation, you can also try angalia December 2013. December 2013. Hiyo ni ya PE, December 2013. Question December 2013, look at question 3. Naitwa Mr. Maru. December 2013. Hii inaitwa Mr. Maru. Hiyo ni PE investigation. We'll get some time, try them. We'll be looking at that even as we conclude. Sawa sawa, tumemaliza kwa siku ya leo.
And then